Let's explore how capital gains tax works when you decide to sell your mutual fund units. When an investor sells units of a scheme, the selling price they receive might be different from the purchase price they paid when they first bought them. This gap between what you paid and what you received is what we call a capital gain or a capital loss. Building on that basic definition, the actual result of your sale is dictated by which price is higher. If your selling price is higher than your purchase price, you have achieved a capital gain. But if the selling price is lower than what you paid, you have experienced a capital loss. It is very important to remember that these capital gains are subject to tax under the law. Now that we understand what a gain is, let's look at how the government classifies them, because the tax rate depends on two main things: the period of holding and the type of funds you invested in. Because of these factors, capital gains tax is split into two categories, which are short-term capital gains or STCG and long-term capital gains or LTCG. To help us categorize these assets correctly, we use two specific holding periods, 12 months and 24 months. For all listed securities and units of equity-oriented funds, the threshold is 12 months, while for all other types of assets, the holding period used for classification is 24 months. Building on that logic, let's look at a quick application example to see how this works in real life. If you sell units of an equity-oriented mutual fund after holding them for a period of more than 12 months, those specific profits are classified as long-term capital gains. Now that we know how gains are classified, it is time to discuss a very helpful benefit called the exemption of up to 1.25 lakh rupees. For long-term capital gains that come from equity shares or equity-oriented mutual funds, the tax only applies to the portion of the profit that goes above 1.25 lakh rupees. This means the first 1.25 lakh rupees of your long-term profit in this category is completely tax exempt. To make this concept even clearer, let's compare two different scenarios. In the first case, if an investor earns a total long-term capital gain of 90,000 rupees in a year, the entire amount is below the limit, so the entire gain would be exempt from tax. However, if the total gain is 1,35,000 rupees, the first 1,25,000 rupees is exempt, but the remaining 10,000 rupees will be subject to tax. Moving forward from exemptions, let's look at the specific tax regulations for equity-oriented funds, which includes hybrid funds with more than 65% in equity and equity ETFs. For these assets, if you sell within a holding period of 12 months, it is considered STCG and taxed at 20%. If you hold for more than 12 months, it becomes LTCG and is taxed at 12.50%. Keeping in mind that 1.25 lakh rupees annual exemption we just discussed. While equity has its own set of rules, debt-oriented funds, which include hybrid funds with more than 65% in debt, follow a different path. These are always taxed as STCG, regardless of how long you hold them. This means the gains are always added to the total income of the individual and taxed according to your specific marginal slab rate. Building on the variety of funds available, we also have hybrid mutual funds that keep between 35% to 65% in domestic equities. For these funds, if you hold them for up to 24 months, the profit is STCG and is taxed at your marginal slab rate by adding the gains to your income. If you hold them for more than 24 months, the profit is classified as LTCG and is taxed at a rate of 12.50%. Continuing with our look at different categories, we find other mutual funds like fund of funds and international funds. These follow the same timeline as the previous hybrid funds, where gains from a holding period of up to 24 months are STCG and taxed at your marginal slab rate. Once you pass that 24-month mark, the gains are considered LTCG and are taxed at 12.50%. Now, let's consider another popular investment, which is gold ETF. For these, the holding period for classification is 12 months. If you sell within 12 months, the profit is STCG and taxed at your marginal slab rate. If you hold your gold ETFs for more than 12 months, the profit is classified as LTCG and is taxed at 12.50%. To bring everything we have discussed in this video together, let's summarize the rules for different investment assets. Equity-oriented funds have a 12-month threshold with a 20% short-term tax and a 12.50%. Long-term tax. Debt funds are always short-term and taxed at your slab rate. Hybrid funds with 35 to 65% equity and international funds use a 24-month threshold for their 12.50% long-term rate, while gold ETFs use a 12-month threshold for that same 12.50% long-term tax rate.